Hi everyone, it's Professor Reiko here, continuing our lessons on the accounting cycle. So this is our third lesson in the accounting cycle, which, as we talked about in the first video, would be one of your early chapters in intermediate. The accounting cycle, if you look up here at the top of the page, just kind of the how we go about doing that. We've talked about the accounting equation and how transaction affect the accounting equation, but now what we're going to do is get into actual journal entries, and then so journal entries are your first step. Okay, we just do those chronologically as they happen. So, if a transaction occurs, we record the journal entry and just do them in the order that they occur. All right, the second process will be posting to the general ledger. All right, so this can be done like at the end of a period, at the month, quarter, whatever period you're looking at. All right, so this is kind of our first stage of summarizing our information for the month or period or whatever we're looking at. The third step is the trial balance, which is just kind of a listing of all our accounts to ensure our debits and credits equal. And then we do adjusting journal entries. So this is probably the hardest part. We'll get to these in the later videos. But adjusting journal entries typically give students the most trouble. These are our accrual entries and deferrals and things like that. And we'll cover those in detail in a later lesson. And then we have the adjusted trial balance, which is just a new trial balance that takes into account the adjusting journal entries. And then we're ready to do our financial statements. And then we finish off with some closing entries to close out accounts that need to be closed. And we'll get to all this in detail. All right, so what we're going to do is just walk through some journal entries. So if you're an intermediate student, once again, this should be review for you. If you're somebody that's just in a principles of financial or a financial accounting class, this will be new, but once again, it is the foundation. You have to be able to do journal entries, understand normal account balances, and things like that. So let's just walk through our transactions here. All right, so if we look at our first one here, we issued stock for $80,000 in cash. All right, so when we do this, if we're getting cash, always use your keywords. It says we're getting cash, so we're debiting cash for $80,000. All right, and we issued stock, so we'll just call that common stock for $80,000. All right, so if you think about what's going on here, scroll down here a little bit. The company is issuing stock. All right, they're issuing stock to increase their capital. Okay, so they get cash, an inflow of cash, and now they have money to go about buying stuff and things like that. All right, so once again, cash is an asset. It's a normal debit balance. Common stock is an equity balance. It's a normal credit balance. So that's why we debit cash and credit common stock, because both of those accounts are increasing. All right, so now that we have this cash, we use some of it to buy some machinery. All right, so remember, machinery is an asset. All right, so we'll debit machinery for $11,000, and then it says we're paying cash for it. All right, so remember, cash is a normal debit balance, so this credit right here reduces it. So now if you look at our two, we did have $80,000 in cash. We just spent 11, so now we have $69,000 in cash. All right, so this is, if you think about the accounting equation, we have an asset machinery going up, an asset cash going down by the same amount, so the accounting equation holds. All right, our next step, we purchase inventory, $20,000 on account. All right, so once again, use your keywords. When you see on account, that means we're not paying for it right now. All right, so we purchased inventory. So inventory is an asset. So we'll debit it because it's a normal debit balance. And anytime, like I said, on account means instead of crediting cash here, we're going to credit accounts payable, which means we owe that $20,000. All right. The next one, purchased land and signed a $22,000 promissory note. All right. So land is an asset. We're going to debit land for $22,000. And we signed a note, meaning we didn't pay for it. A note just means we're going to pay for it later, and there'll probably be some interest that goes along with it. All right, so note payable is a liability, which is a normal credit balance, so that increases it. All right, our last one on this page, we sold $8,000 of inventory. So remember, we had the inventory that we purchased up top. Now we sold that, and notice we sold $8,000 of it, but we sold it for $12,000. So that's just the markup. So we marked it up basically 50% or $4,000. So we paid $8,000 for it. We sold it for $12,000. Right? So that would be our profit. All right, so whenever you sell inventory, there's two transactions. One, you need to record the sale. All right, so we sold it for $12,000. So we have cash coming in the door, $12,000, and we'll just call this sales revenue for $12,000. All right. But we also got rid of some of our inventory. All right. So we need to take inventory off the books, and we do this by debiting cost of goods sold, CGS, cost of goods sold, for 8,000. So that's essentially a expense account on your income statement, and then we will take the inventory off the books. All right. So now we have 12,000 of inventory. We had 20,000 up here, and now we have sold 8,000, so we have 12,000 left. All right, so if you think about it, sales revenue, so these two accounts right here, sales revenue and cost of goods sold, both go on our income statement. So our profit is, we have sales revenue less cost of goods sold, so our profit on this transaction was $4,000. All right, if we flip over to the next page, all right, and we'll walk through these. So we paid for half of the inventory purchased above. So remember, when we bought the inventory, we bought it on account, meaning we haven't paid for it yet. All right. So now what we're going to do is pay for it. All right. So remember, we had a credit to accounts payable, and we were paying for 20,000, but we're paying half of it, so 10,000. And now is when we have the credit to cash, because we're actually paying a portion of what we owed. All right. Next step, paid off the promissory note plus interest. All right, so remember, when we bought the land, we signed a note for it. So we're now paying that note off, all right? So the note payable comes off the books, all right? So remember, on the previous page, we had a credit to note payable of 22. We now have a debit to note payable of 22, which means that account is now zero. But that makes sense because we're paying off what we owed, so that account should be zeroed out now. We also had interest, and so we'll just call that interest expense. Remember, all expenses, go back to the first accounting cycle video, expenses are debit balances. So that's why we have that. And then we're paying for both. So we're paying off the note plus the interest. So we're paying $23,000. All right, our next one, we sold some more inventory. So this is going to look similar to the one on the previous page, but notice here is we sold it on account. All right, so once again, we marked it up 50%, so 2,000 to sell it for 6. So we're going to have same journal entries for the most part. The only difference is we're not getting cash right off the bat. So we're still recording sales revenue, but remember, accounts receivable just means they're going to pay us later. A receivable means somebody owes us money. All right, and then we still have to do our cost of goods sold and inventory for the 4,000 for the cost of the inventory. So once again, we made $2,000 on this transaction. All right, so our last few, we collected $3,500 from customers with account balance. So let me just scroll back up real quick. So here, right here, they owed us $6,000. We are now collecting a portion of that. So how we go about doing that? So we're now receiving the cash. So I'm going to debit cash for $3,500, and I'm going to credit accounts receivable for $3,500. So they did owe us $6,000. They just paid $35,000, so they still owe us $2,500 more that we'll hopefully collect later. All right, we paid our employees. Okay, so we'll just call this salary and wages expense. So typically the difference between salaries and wages is salaries are people that are on salary. Wages are typically for people that are hourly. We don't really distinguish here, so we'll just lump them all together into salary, wages, expense. It says we're paying them, so that means we're going to have a credit to cash for $2,300. All right, our last one is depreciation. All right, so anytime you have depreciation, your journal entry is always debit depreciation expense. Oops, don't need that last zero, sorry. And we credit accumulated depreciation. So I abbreviate that. That's accumulated depreciation. All right, and we'll get into more detail on depreciation, but this account right here is what's called a contra asset account, and we'll talk about that in a little bit. So these 2 pages are just some basic journal entries. Once again, if you're an intermediate student, hopefully this is just review for you. However, your first test is going to be over all this stuff, and so you really want to get off, because intermediate typically moves pretty quick for some people, and so you really want to get off on the right foot as far as your first test goes. And typically that will cover the first 3 to 4 to 5 chapters. So there's a lot of information, but a lot of it is review, so it gives you a chance to really get off to a good start if you kind of get ahead on this stuff. All right, so once again, I hope you enjoyed the video. Hopefully this helps a little bit with just kind of remembering journal entries. If you like it, please hit the like button. I'd love if you subscribe to my channel. And hopefully I'll be posting more videos throughout the whole intermediate, all the chapters in the book. Thanks.